Welcome to the next installment in the video lecture series for the American Economic History course online here at Rutgers University. And in this section relates to Chapter 13 in your textbook, American Economic History by Jonathan Hughes and Louis P. Kane, as I'm reading off the title and names off the cover of the book here. And here we are talking about the Civil War. All right, as you should well know, that it was a turning point in the history of the United States, and an important concept to understand is the impact of the Civil War, but in particular, how to contrast the experiences of the North versus the South in economic terms, taking a look at, for example, the differences in the costs to the two regions, the differences and issues related to trying to finance the war, raise money to execute the war. How was the inflationary experience different between the North and the South, etc. So make sure you realize that that's the perspective that we're going to be taking a look at the Civil War and how we can interpret the financing and the outcome of the war from the perspective of an economist. So again, to understand the costs of the war, but particular to understand the differences in the costs between the North and the South, the different mechanisms that were available to the North and the South, and which ones the North was more likely to avail themselves of, and what kind of avenues of finance that were not available to the South. We'll also take a look at some notions as to the exact impact of the war on industrialization. We'll take a look at the Beard-Hacker thesis, which in essence states that the Civil War was a driving force in the industrialization of the United States. And then we'll look at people who counter that and argue that that's not necessarily the case. So Beard and Hacker have the notion that the Civil War was an impetus to further industrialization and help to quicken the pace of industrialization in the United States. And then we have other individuals who have a counterpoint to that argument of Beard and Hacker. Then we'll take a look at the difference between the recovery after the war. In particular, how did the South do? How long did it take the South to recover? And what happened in the North? And then also we're going to take a look at sort of wealth distribution prior to the Civil War by region, and then look at that after the Civil War. And finally, we'll take a look at something called country finance, taking a look at the financial markets that developed in the South after the Civil War. And this is an important concept because there's a notion that with the collapse and the loss by the South, that much of the financial system of the South started to collapse. And that we end up seeing this thing called country finance, whereby many people became reliant on the local storekeeper, the individual who provided materials for these small rural locations. And there's an argument that's put forth by Ransom and Such that these individuals enjoyed monopoly power in sales, but also monopoly power in the provision of credit. So we'll talk a little bit about their notion, why they come to the conclusion of this monopoly power by storekeepers in these rural regions of the South, and go through their explanation in detail. It's a controversial assertion that they make, but it's a well-positioned argument that they make. So let's take a look at the direct costs. If we're talking about the war, what type of direct costs actually occurred from loss of life, etc. All right, if you take a look at the prime-aged male population, roughly 9% of the male population in the United States lost their lives during the Civil War. All right, if you use the loss of human capital and use this estimate of $1.2 billion that is propounded, uses the value of life as the equivalent of what a prime male slave was worth at around 1860. roughly $2,000 for a slave, a prime male slave hand. So that's where that number comes up, that $2,000 for. So for every life that was lost, they're worth about $2,000. Now you can understand the dubious nature of this. Number one, placing a value on human life is a difficult thing to do, and secondly, remember that the slaves themselves were forced into that condition. So that is very much a lower bound estimate. I mean, you can imagine, I think your book points out that if you went to a household and said, we want to kill your son, your 18-year-old son, here's $2,000, how many people would have accepted that offer? Very, very few. Maybe some would have willingly if they had difficult children, but that is beside the point. So realize where that number comes from. It's the equivalent in slave lives, and most people would easily argue that that understates the value of life during that time period. If they take the risk premium approach, in essence, the risk premium approach uses the fact that in order for individuals to engage in a riskier activity, they have to get a risk premium in order to accept that risk. So let me give you an example. If you watch TV, there's a TV show, I forget, on the History Channel called The Deadliest Catch, and these individuals fish out on the Bering Sea and catch fish. They catch crabs. And it's a very risky job, but they get compensated very well for that risk. Those individuals get very high salaries. So whatever the inducement is necessary to take a riskier job, in essence, the person who accepts that is basically putting a value on their life. If they accept a 10% higher chance of dying for an extra amount of pay, you can calculate how much value they place on their lives. And if you take the risk premium approach from that time period, you roughly get the loss of life equal to $1.8 billion. Also realize that government expenditures is a direct measure of the cost of the war. Government expenditures were roughly $3.3 billion. And realize that that doesn't seem like much now, but that was well in excess of the yearly expenditures of the federal government prior to the start of the Civil War. And the amount of property that was destroyed during the time period was roughly $1.5 billion. All right, so if you take a total look at the cost, you can see that they were pretty much evenly distributed between the North and the South. $3.4 billion in the North, $3.3 billion in the South. But to give that some type of relative value to, $3.3 billion doesn't seem much today, but let's place it in the comparison of the time period. So if we take a look at the years 1850 to 1860, that was roughly 2 times the value of all exports for the United States for a 10-year period. If you take a look at 1860, that $6.7 billion was twice national income. So the destruction was twice the amount of national income for one particular year. And if you look at that amount, and that number there is incorrect. That should be 1779, not 1879. Apologies for that. But that's close to $7 billion was 4 times the amount of government expenditures from 1779 to 1860. So you could see just a relative value that was a huge cost imposed upon the nation during that time period. What was the relative? Let's give some other relative value to this. For example, for those costs, you could have purchased all the slaves at prevailing slave prices at that time, given all of them 40 acres of land and a mule, and that would have cost less by $3.5 billion than the entire cost of the war. So that just gives you a relative amount of the war. Also realize that those costs sometimes are also underestimated, because remember, we only included the lost life and destroyed property, etc. We do not include the individuals, for example, that lost arms or lost legs or suffered horrific injuries during that time period. So it does not include the costs to the individuals who lived through the war but had experienced cost well through their entire life after the war. So financing, we could take two approaches to taking a look at financing. You can directly tax somebody. So you can have a tariff, an income tax, a sales tax. These are all direct taxes that you can see. When I go to the store and purchase something, they add 7% onto the price that they collect in the form of taxes. Tariffs, etc., are all direct. Indirect is in the form of higher prices that you can engage in financing the war by printing money, and that money depreciates in value. And the holders of that money see the value of that paper money depreciate, and they lose value. It's oftentimes referred to as the hidden tax, and inflation is the hidden tax or the indirect tax. So just realize that when we talk about financing and taxation, you can directly tax an individual, and then if you engage in financing by printing money and having inflation and having the value of your currency depreciate, sometimes that's considered a hidden tax or an indirect tax. Well, let's take a look at the scope of the budget in the United States and how this changed federal finance during the time period. If you take a look, in 1860, federal government revenues were $5.6 million. Okay? By the end of the war, by 1865, federal revenues were $333 million, almost a six-fold increase in government revenues from 1860 to 1865. So you can see that the federal government dramatically increased the amount of revenues it generated in order to execute the war. Let's take a look at things from the expenditure side. In 1860, the federal government's budget was $63 million. By 1865, that grew to $1.3 billion, a 20-fold increase in the level of expenditures from 1860 to 1865. So we can see a dramatic increase in the resources being purchased by the federal government during this 5-year time period of the Civil War. Let's take a look at what happens to the deficit. The government was in deficit by $7 million in 1860. By 1865, this deficit had increased to close to $1 billion, almost a 140-fold increase in the level of the deficit. And then you can see our overall debt, how much money we owed overall. In 1860, our total debt that we owed was roughly $65 million. By the end of the war, that had grown to $2.7 billion. So the reason why I think this table is important is that you can see, number one, on the expenditure side, the importance of federal expenditures, how dramatically they increased prior to the Civil War. A 20-fold increase in expenditures from 1860 to 1865. How was this paid for? Well, revenues did go up, but revenues didn't go up anywhere near the rate that expenditures did. It was a 20-fold increase in expenditures and a 6-fold increase in revenues. What did that translate to? Growing and growing deficits. Deficit grew by almost a 140-fold between 1860 and 1865. And our total debt, the total money the entire country owed for all of its deficits prior to that, grew by 41-fold. So you can see this has a dramatic impact on federal finance, on the revenue and expenditure side. So we went from just barely having a deficit to running massive deficits, and our total gross debt mushroomed dramatically because of the Civil War. All right. So realize that that's just a overview of what I just talked about in that previous slide. Realize that one of the ways that the federal government financed the war was in the printing of money, and they issued these things called greenbacks. They were called greenbacks because the back of them were a green color. They did produce these in large amounts, and there was inflation associated with the issuing of greenbacks. All right. The thing you should know about the Confederacy is that financing the Civil War was much more difficult for the South, for the Confederacy. All right. They were less able to raise money through taxation. Only 12% of their expenditures were generated through taxation. Number one is they didn't have a tax mechanism in place to begin with. They weren't a government, a federalized government or a confederacy, so there was no centralized government, so they had no centralized taxing mechanism. So they had no way of collecting the money, and it was very difficult for them to actually collect the money since they had no mechanism for enforcing these taxes. All right. The main vehicle that was available to them was to print money. And in the South experienced what is considered hyperinflation. All right, the prices during the time of the Civil War, in terms of their paper money, increased by 95-fold. Prices were 92 times higher than they were at the start of the war. So let me give you an example. If you go into the student center, go to the cafeteria and buy a bottle of soda, it costs $2. Imagine 5 years later going in and having to pay $184 for the same exact bottle of soda. That gives you an indication of the level of inflation or hyperinflation that existed in the Confederacy. And the main reason for this is that they failed to make paper money legal tender. If you take money out of your pocket, the dollar, it says right on the face. I'm reaching into my pocket now to pull out some cash. And it says right on the front left-hand side, this note is legal tender for all debts, public and private. Confederacy failed to do that, so people could legally not accept that money and say, we're not accepting it. So that undermined the value of the Confederate currency, along with the fact that it was printed well beyond the Confederacy's means to redeem that paper money. People started to lose faith in it, and it depreciated greatly in value through the course of the Civil War. So let's take a look at money prices in 1860, 1865, and 1869. So you can see, and this is for the North, we can see that the money stock increased by 2.5 times from 1860 to 1865. So this gives you some indication of how the North partially relied on increases on the money supply to finance the Civil War. Also realize that what impact this had on wholesale prices. Wholesale prices doubled in that 5-year period. All right, so roughly the inflation rate ran somewhere around 15%, 15% for that 5-year period. So you can imagine inflation running 15% every year, but realize that in the South, wholesale prices went up by a 92-fold. So these doubled, where in the Confederacy they went up 92 times. All right, and the cost of living also increased roughly by 75% during that time period. So just realize that in the North, both the North and the South relied on printing money to finance the war. The difference is that in the Confederacy there was hyperinflation. The paper currency dramatically decreased in value. The reason why they were so reliant on the printing of paper money is they had an inability to tax and to collect those taxes. So the infrastructure and the tax enforcement mechanism in the North was more developed than it was in the South. So the North could rely on taxation and the collection of taxes to finance the war, where the South couldn't. Also, the other limitation is that you can borrow money in order to finance the war. The issue was that people felt that the North was a safer investment. Because if you realize that if you fight a war, a revolutionary war, just like during the Revolutionary War with us in Great Britain, if you lose, those debts aren't going to get paid. So a lot of people were of the conviction that Confederacy wasn't going to win; they were going to lose. And why would you lend money to a nation that is no longer going to be a nation? The North's not going to pay the debts of the South that they accrued to try to gain independence or separate themselves from the federal government. So the South was very limited in the fact that they couldn't tax and collect taxes. Two, they were limited in how much money they could borrow. So that left the third vehicle to them where they had to print money in greater amounts than was printed in the North. All right, let's take a look at what happened to imports and exports during this time period. You can see that the Civil War had a dramatic impact on imports and exports. You see that our exports declined during the Civil War, and you can also see that the level of imports declined. But the other important thing to realize is what ends up happening to us. We shift from a net exporter of goods to a net importer of goods for the next 5-year brackets from 61 to 65 and 66 to 70. All right, so make sure you realize that on the import side of things, the Civil War had a dramatic impact. We see 15% decrease, no, more than a 15%, about 20% decrease in exports, and roughly the same amount in imports during that time period. Now, the traditional view of the impact of the Civil War on industrialization, and this is the Beard-Hacker thesis, is that the Civil War was the origin of U.S. industrialization, that U.S. industrialization picked up and accelerated during the Civil War, that the pace of industrialization was aided by the Civil War. And the argument is that you see during this time period that financiers and industrialists see large financial gains during the Civil War. Those individuals become wealthier and wealthier during the Civil War, and it was because of the demands for production, the fact that the federal government had to buy resources, buy guns, booze, clothing, etc., that financing the war had to take place. And all of this was an increase in demand for those services, and we saw that industrialization and further development of the financial markets was pushed by the Civil War. So make sure you realize that that's the Beard-Hacker thesis, that the Civil War was a net benefit to industrialization. It quickened the pace of industrialization because of the demand for additional production that occurred from the federal government in the execution of the war. Now, some people argue against this. Number one, if you think about this, when you wage war, what happens? Those resources are taken away from the labor market. All those individuals who were in the army weren't producing items. So you're net pulling away resources that would have been available to produce goods and services, and now those individuals are out fighting a war and dying and getting hurt and having horrific injuries that lower their productivity in the future or prevent them from working at all. All right, so realize that the war was draining resources. The whole notion of opportunity cost and economics, all the resources that were being put in place to execute the war were not being put in place to produce goods and services in the economy. The other argument that they look at is, if you take a look at the growth of GDP for the 20-year period prior to the Civil War, we see that there's about a 4.6% rate of growth for that 20-year period from 1840 to 1860. If we look at the decade of the Civil War, GDP only grew by 2%. And then if we look at the 30-year period after the 1870s, we see that GDP again grew by 4.4%. So their argument that the Civil War aided industrialization, but the decade where the Civil War actually occurred, economic growth was much slower. There's a trend of roughly 4.5%, and it's much lower during the decade where the Civil War was prosecuted. So that's not evidence that the Civil War aided industrialization. It actually pulled away resources away from productively producing things within the economy. All right, now also the other example they use to sort of rebut the Beard-Hacker thesis is that if you take a look at this time period, 1855 to 1865, here's a war industry, shoe and boot production. All right, if you're in the army, you need army boots, correct? So you would imagine that during the time period of 50 to 60 to 65, you would see a dramatic increase in shoe production. Well, what do we see? Actually, during that time period, we see a decrease in shoe production. And we also see about a 30% decrease in employment. So if the war itself was a spur to industrialization and production, an industry that's closely aligned with war production actually sees dramatic declines and actually a great deal of shrinkage in production and employment during that time period. Also, if we take a look at another related industry, the farm industry, little increase in farm output. That farms were pretty much stagnant during this time period, so we're not seeing this translation of increased productivity to the farm sector. All right, so if we take a look at the miles of railroad built, we can see here that if we look at the time frame of the Civil War, particularly 1860 to 1865, you can see that this is well below the levels of miles of railroad built for the period before and after. So again, this figure 13.1 is sort of pointing out a weakness of the Beard-Hacker thesis. Beard-Hacker is saying that the Civil War was a push for further industrialization. Here you can see that railroad production suffered greatly during the Civil War. The miles of track produced during the Civil War was much below the levels prior to the Civil War and after the Civil War. So again, this is pointing out a weakness of the Beard-Hacker thesis. If the Beard-Hacker thesis were true, one would expect to see greater amounts of miles of railroad built in the United States during the Civil War. Now, let's take a look at the comparative recovery between the two regions and compare them to see who was made better off or worse off by the Civil War. If we take a look at per capita output in the South versus the non-South, we can see that they're roughly equal to one another. In the South, per capita output was equal to roughly $78, and the non-Southern states it was $75. We go to the next 10-year period, 1870, we can see that the South sees a dramatic decrease in per capita output. Roughly a 40% decrease in per capita output, while the non-Southern states see a slight increase, roughly a 10% increase. So prior to the Civil War, per capita output was roughly equal between the South and the non-South. But when we look at 1870, 10 years after 1860, we can see that there's a dramatic decrease in Southern per capita output. All right, roughly, like I said, 40% decrease, while the non-Southern states see roughly a 10% increase. And then if we go even further to 1880, we can see that the South still has not gotten back to its 1860 levels. In 1880, per capita output was equal to $60 per person, and in 1860 it was $78 per person. And in the non-Southern states, we see that output has even increased even further. So the one thing I want you to realize is that in terms of economic and productivity, the South very much, the Civil War very much undercut the South in per capita output. So let's take a look at different sectors of the economy here. So we're going to talk about commodity output, South versus non-South, and take a look at a couple of different sectors. If we take a look at overall production in the non-South, In 1860, the index is equal to 100. 10 years later, that index goes to 140. So from 1860 to 1870, total commodity output increases by 40% in the non-South. For the same time period in the South, for total commodity output, we see a 25% decrease. All right. If we take a look at the mining and agricultural business, from 1860 to 1870 in the non-South, we see roughly a 46% increase in commodity output. And once again, in the South, we see a 25% decrease in commodity output for mining and agriculture. If we take a look at manufacturing in the non-South, from 1860 to 1870, we see a 33% increase in commodity output and a 20% decrease in the South. If we compare going into 1880, we can see that in the South, yes, we see an increase, about an 18% increase from 1860. But what do we see? 132% increase in the non-South during that same time period. And the same thing holds for mining and agriculture. We see about a 15% increase in the South in commodity output in the South from 1860 to 1880. And we see a more than doubling of commodity output in mining and agriculture in the non-South. Same thing for manufacturing. In the non-South, about a 250% increase. And we only see a 40% increase in the South. So this just gives you information about how different the pace of recovery was after the Civil War. That the South very much lagged behind the North in the post-Civil War world. Now, why is this the case? Well, about 30% of Southern wealth was destroyed after the Civil War, whether it was directly or, remember that under the slave labor system, the slaves themselves were assets that were held by the Southerners. So the freeing of the slaves actually decreased the wealth of Southerners. So between the wartime destruction and the freeing of the slaves, about 30% of Southern wealth was eliminated. Also, during this time period, we see real estate in the South falling, farm real estate falling by about 50%. Again, this being, and a portion of the explanation of this is that with the abolition of slavery, that those land values are associated with the higher levels of productivity associated with slave labor. With the elimination of the slave labor system, those lands became less productive and then less valuable. No comparable post-war Marshall Plan. After World War II, we'll talk about this later, there was the Marshall Plan where the United States lent funds for the rebuilding of Europe. Well, after the Civil War, obviously the Northerners were not too keen on giving money to the South in order for them to rebuild. So there was no investment or decreased levels of investment in the South, so they weren't able to rebuild after the Civil War. Also, the financial system, the banking system, virtually completely collapsed in the South. Roughly 90% of the state banks that existed prior to the Civil War went out of business. All right? And also remember, as I said previously for some of these examples, the labor markets completely collapsed in the South. Remember that this was all underpinned by a slave labor system. Once the slave labor system was abolished, there was difficulty in the labor markets adjusting to this. So you have a system that's highly reliant on slave labor, and once that system becomes abolished, there's going to be some upheaval in the local labor markets, and it took a while for there to be an adjustment to the abolition of slavery. Also, the reason why the South was so hard hit was that after the Civil War, cotton prices declined dramatically. Remember, much of the Southern economy was underpinned by the Industrial Revolution and the demand for cotton that was coming for Great Britain and their textile industries. So in 1865, cotton was roughly 43 cents a pound. 4 years later, it had fallen to 15 cents per pound. So you can see that the changes in the world market for cotton, and the decline in prices is adversely affecting revenues being generated by the farms and the cotton farms in the South. And then if we go from 1870 on, the prices fell even further, close to 10 cents per pound. So the Southern economy was so closely welded to uh, to to cotton agriculture that as the world price of this fell, that dramatically undercut the revenues that were generated by the farming system that underpinned much of agriculture in the South. And the other thing that's important to realize that cotton prices, even though prices fell during this time period, it was a deflationary period in the United States in general, but also realize that cotton prices fell faster than other prices. So the thing that occurred here is that the purchasing power of cotton was falling relative to other items. So even though cotton was all prices were falling, cotton prices were falling even faster. So this meant that in essence, the purchasing power of individuals who were growing cotton was falling faster than for other agricultural outputs. All right. Also, I've also addressed this emancipation. That represents about 40% of property loss. Also, as I said, that the issue that here is that you have a labor force that was enslaved, and now you free them, and they have no property, they have no money, they are unskilled workers, so you end up causing all kinds of disruptions in labor markets because of the emancipation of the slaves. Now, if we take a look at this, what ends up developing is this thing called sharecropping, and I'll go over what sharecropping is, but why it was disproportionate. Sharecropping was disproportionately larger along for freed slaves than it was whites. If you take a look at in the South, all lands and crops, roughly 70% of the land in the Cotton South was occupied by white individuals, and 30% was occupied by freed slaves. All right. Now, if we take a look at white individuals, almost 75% of them actually owned the land, while only 26% rented the land. If we take a look at the freed slaves, you see almost the opposite is the case. It seemed there that for freed slaves, they were more likely to rent land than they were to own land. So the renting of land was much more important to freed slaves than it was for whites who occupied land in the Cotton South. All right, so they were more likely, the freed slaves were more likely to be renters on their land, or land tenants. It's probably the best way to say it. So the main difference between the freed slaves and white individuals in the South who were landowners is that vast majority of freed slaves were tenanted on the land. They did not own the land, whereas a much smaller proportion were tenanted that were white individuals. So if we take a look at the freed slaves, of those who were tenanted, they engaged in sharecropping. And sharecropping is basically you don't pay your rent based on money, you pay your rent as a proportion of the output that you generate on that land. So even though that proportion is the same for those who were tenanted, much fewer white individuals were tenanted on land. They actually had a higher land ownership rate, and it was more likely that individuals who tenanted land in the South for freed slaves, they were more likely to be engaged in a sharecropping arrangement, which meant that they didn't pay rent in terms of money, they paid rent in terms of a proportion of their output. And much of the argument about sharecropping is that it's a form of debt peonage. It's a form where you're going to be impoverished, and the likelihood of you getting out of poverty is very, very small. So realize that that's a portion of the issue with the South, is that the proportion of individuals who sharecropped was much higher among freed slaves than among white individuals. So country finance, this sort of developed after the Civil War, and the reason I want you to be aware of this is there's two reasons. There were two vehicles for finance that were available prior to the Civil War. One relates to the prevalence of cotton and the dominance of cotton in agriculture, and also with the banking system. Make sure you realize that a lot of the finance that was provided prior to the Civil War was related to these individuals who were called cotton factors. They were representatives of the textile industry who were purchasers of cotton and shipping them to Great Britain, but they were also vehicles for loaning or borrowing for Southerners to borrow money. And they were very much tied to the plantation system because they were tied to these large-scale production. They had to buy large quantities of cotton in the South. So they were very much tied to the plantation system, and they knew the plantation owners during this time period, and they had a good idea of how financially viable they were, and if they needed credit, they were a good source of determining who was creditworthy and who they should lend money to. So with the downfall of the plantation system, we end up seeing these cotton factors disappearing, which is important that we'll talk about later because that's a source of financing that is no longer available in the South after the end of the Civil War and the demise of the plantation system. So there's a form of finance that is no longer available post-Civil War. Also, the National Bank Acts were passed in the North during the Civil War, which put capital requirements on any banks that joined the national banking system. And these capital requirements were quite strict, and it was difficult for Southern banks, particularly since so many of them went out of business, 90% during the Civil War, that it was difficult for Southern bankers to meet these capital requirements. So this meant that there were relatively fewer Southern banks available than there were in the North because of the National Bank Acts. All right. Also, because there was very few urbanization centers, that meant that there was not an aggregation of enough wealth in order to meet those capital requirements. So realize that there were deficiencies in the capital markets in the South because of the demise of the plantation system. Why? Because those cotton factors were tied to the plantation system, and those cotton factors actually lent out money and provided financing to individuals, to the plantation owners, and to other individuals in the South. Once the plantation system died, the cotton factors died, and the finance that they provided died along with them. When you couple that with the fact with the National Banking Act and their strict capital requirements or the higher capital requirements, and the fact that there were very few urban centers that allowed for the accumulation of concentrations of capital, we end up seeing fewer Southern banks. So we don't have as many banks in the South as we do as the North, and a main financing mechanism, the cotton factors, disappear from the South. So if we take a look at the national banks, we can see that in 1880 there were over 2,000 national banks in the United States. Only 126 of these were in the old Confederate states, and only 42 of those were in cotton-growing states. So you can see that the South and the cotton-growing regions are underrepresented by the number of national banks, which undercuts the ability for individuals to borrow money. Also, the banks that did exist had a tendency to be much smaller than the banks in the North. Now, this led to a peculiar situation where you have the cotton factors are gone, their finance is gone. You have fewer banks and smaller banks in the South. So the financing that used to be available and the capital markets that used to exist prior to the Civil War no longer exist. So where does that financing come from? And Ransom and Such bring up in their book is that the merchant, the local storekeeper, ends up being the provider of local finance. And this ends up setting up they end up charging usury rates. And usury is a term that's used to describe very high interest rates. So if you have usury laws in your state, they set maximum interest rates that are allowed to be charged in the state. Well, these merchants, the storekeepers, were selling goods selling goods to these individuals, but they were also selling those goods, providing them on credit. And Ransom and Such took a look at the terms of these merchants, these provisioning merchants in these rural areas, and they found that the interest rates that they were charging were 10 times higher on average than the interest rates in the urban setting. So where you had concentrations of population, you would see interest rates of 4 to 7%. And when they took a look at the contracts that these individuals, the provisioning merchants, had with local farmers, they found that the interest rates were roughly 40 to 70%. So that's what I mean by usury. So if you see any term that relates to usury, usury is associated with high levels of interest. All right. So they argue, Ransom and Such argue, that there's a response, that these local merchants, these local storekeepers, responded to the lack of credit that was available and the lack of banks and the lack of cotton factors by assuming the role of financier and lending out money. All right. Also realize that during this time period that um, there was a propensity for state laws to allow crop liens, which meant that if you owed money, an individual could get a percentage of your crops in order to satisfy that debt. So if you owed me money, I could get first crack at the cotton or tobacco or anything that you produced or grew as a farmer in order to satisfy the money that you owed me. So make sure you remember Ransom and Such and the whole notion of one kind of freedom. They're the ones that espouse the notion that the storekeepers themselves attained some monopoly power. Number one, because there were high transaction and transportation costs, and because there were so few banks out there, it was difficult for individuals to get from the rural areas to these urban areas, and that increased the level of transaction costs and transportation costs. And because of the dispersion of stores, they were able to maintain some type of monopoly power over individuals because they were the sole supplier of credit. That if you wanted something, they would sell it to you on credit, and they were able to charge you a very high interest rate in order to do that.